Hi, and welcome to Your Money, Your Taxes, and Your Wealth. My name is Jarod Bloom, and I'll be your host. Today we're going to talk about taxes for trusts, taxes for estates, and also the gift tax. My guest today is Nancy Vaccaro. She's my colleague at Schrest Bloom. Nancy, thanks for being on the show.
Thank you for inviting me. Pleasure to be here.
Great. So let's start off by, first of all, what is a trust? What is an estate?
Basically, a trust is a separate legal entity. It's set up to hold property. There's basically three parties to a trust. There's the grantor, and that's the person who sets up the trust. There are beneficiaries, and those are the people that benefit from the trust. And then there's a trustee, and that's the person who actually administers the trust. And one of the things sometimes people do is they'll set up this trust, they'll have this wonderful trust drafted, but it's also important to remember you need to fund the trust. And so we can also help with that aspect of it as well. But generally, trusts are set up to control what happens to an asset during a person's life and after they pass away.
Okay, so it's a separate legal entity, and generally there's two kinds of trusts. There's revocable trusts and there's irrevocable trusts. So as the name implies, revocable trusts can be changed or revoked at any time. Irrevocable trusts are irrevocable. You can't change it once you've done the trust. Can you talk a little bit about those differences?
A lot of times what people will do is they'll set up a revocable trust, which is often referred to also as a living trust. And the purpose is that if they become incapacitated or incompetent, that the trustee can then just take over and actually administer those assets. The other advantage of having that type of trust is that it avoids probate for assets that are held in that trust. And that's kind of the difference between a trust and an estate, in the sense that there's the probate estate, meaning that's the assets you have left in your name when you pass away. And then there's an estate for estate tax purposes, which is anything that you actually have an ownership interest in when you pass away.
Okay, so with an estate, now an estate is created, it's a separate legal entity, just like with a trust, but that happens when somebody passes away.
Correct.
So can you talk a little bit about that and the roles in an estate, such as an executor or an executrix?
So basically, an estate is established, as you said, on the day the person passes away. And there's generally a court appointment of generally a personal representative. Sometimes they're called an administrator or executor, but generally they're the person who's responsible for administering all the assets of the estate. And it's important to remember that they do have a fiduciary responsibility, and if there are assets that were left in that person's name, there is a court process that you need to go through called probate, and the executor or the personal administrators are responsible for that. They are also responsible for filing income tax returns for the estate, which is a whole separate issue, which I know is something people don't always think about.
Yep, so I think everybody's pretty familiar with their individual tax return, which is the Form 1040. But trusts and estates have their own income tax return called Form 1041 for federal, and each state may have their own form as well. So can you talk a little bit about 1041 trust and estate returns and how they're different from 1040 individual returns?
Basically, 1041 is a little bit kind of a combination or hybrid, if you will, between an individual return and a partnership return. It's essentially a flow-through return, meaning that if you actually make distributions, then the income is taxed to the person who actually receives the money. If the estate or trust actually holds on to all that income, then it gets taxed at that entity level. It's a separate taxable entity. And that's important to remember because the tax brackets are actually very different for estates and trust. For instance, you actually get in the highest taxable rate at $12,400 in estate or trust. So distribution planning is very critical if you have an estate or trust that generates a significant amount of income.
So you end up hitting the higher tax brackets sooner for a trust or an estate than you do as an individual. And I think the government likely created that system to really incentivize trusts and estates, instead of holding on to the assets, to send those assets to the beneficiaries.
That's correct.
Now, that is, a 1041 is an income tax return for a trust or an estate. But there's also the estate tax. and that's on Form 706 for federal, and each state may have their own state estate tax. So can you just talk a little bit about what is an estate tax?
An estate tax is basically a tax on your assets, or it's basically a transfer tax. And what they look at is they say, okay, what are all the assets in which you have an ownership interest? So that can include real estate, it can include bank accounts, stocks and bonds, any kind of trust that you had some sort of interest in at your death that you had some power to revoke or change, retirement plans. There's a whole host of different things that are included in your estate. So sometimes people get confused saying, well, oh, if it didn't go through probate, why do I have to put it on my estate tax return? Well, probate assets, as I said, are assets that are basically in your individual name, that you didn't name a beneficiary. It all passes through a will. But you can have, for instance, retirement plans are a classic example. Typically, you'll have a named beneficiary. But since you were the owner as of your date of death, the value of that is includable in your estate tax return and subject to estate taxes.
Okay. And of course, this information is all general, but what I find interesting sometimes is people don't realize is if you own a life insurance policy, for example, so let's say you own just $1 million policy and you die, that full $1 million comes into your estate. And you think about that logically and say, well, wait a second, you know, I or the person who owns the policy, you know, died. You don't actually get to use the proceeds. Yet these funds now come into your estate from an estate tax perspective. So I think there's some nuances that people may not be aware of, and it's really important to speak with people like us who are CPAs, speak with your estate planning attorney about these issues, because you may need to plan for them for your estates.
Exactly. And there's planning things that you can do during your lifetime to get things out of your estate. For instance, you had mentioned life insurance. There is a type of trust that can be used to hold life insurance. And if it's set up properly and it's irrevocable and you do it properly, then you can actually have the life insurance outside of your estate. And for very wealthy individuals, that can be very critical, particularly if they own a lot of real estate or their businesses and they don't have a lot of liquidity, meaning assets they can readily sell to pay estate taxes. There are cases where life insurance can be a key part of that in helping provide the assets to pay the estate taxes.
Now there's another return that we haven't talked about yet. There's a gift tax return, or federally it's Form 709. Talk a little bit about the gift tax system in this country and how it's connected to the estate tax system.
This has actually evolved over time, and there was a time where there would be a separate gift tax exemption and a separate estate tax exemption. Now the two are it's called unified, meaning that the amount that you can give away during your life and at your death, it's all connected. So what they do is they have something that's called an annual exclusion amount. So everybody could give up to $14,000 per person per year.
Per calendar year.
Per calendar year, yes. And it's important to remember that. And if it's a husband and wife, then you can each give so in other words, if you had one child, both mom and dad could each give $14,000, so that child could actually receive $28,000 in any given year. And also there's some special exclusions for education. If you pay directly to the school or medical expenses and you pay directly to the provider, that also has its own special exclusion. But the thing to remember is that when you make a taxable gift, there's actually a very large, for federal purposes, exclusion, which is now $5,490,000, I believe. It's a very significant amount. And so the thing to remember when you make a taxable gift doesn't necessarily mean you immediately pay tax. What it just means is it says that counts towards that dollar amount.
So for example, you can give $14,000 per person per calendar year. Well, let's say you gave $20,000 to someone. So now you're $6,000 over that annual limit. So what we're saying here is, well, now you need to file a gift tax return. You need to file a Form 709 to basically disclose that you've made this gift, but you actually don't pay tax or pay cash out of pocket on the $6,000 that you're over. Instead, as you pointed out with the federal exemption amount, right now it's $5,490,000. That amount, or whatever that amount is in your year that you ultimately pass away, gets reduced by the $6,000 overage.
Correct.
So that's kind of how the calculation works. But what's interesting too is that on the state level, there's a different number for the state. So instead of the 5.4 million number for federal, and again, this is all the numbers currently, things can change according to politics. But currently, this number for federal, which is 5.49 million, in Massachusetts, it's a different number. It's a lot less. In fact, it's $1 million. So can you talk a little bit about situations that we've run into with clients where you don't have to file a federal estate tax return, but then it turns out you do have to file a Massachusetts estate tax return?
And that's something important to remember, because a lot of people, they look at the federal exemption amount and say, well, I don't have to worry about estate taxes. But a little history, I think, is helpful. The Massachusetts is like many other states. Several years ago, when the federal exemption was $1 million or less, they had what was called a credit for state taxes. So what all the states did is they did what was called a sponge tax, meaning that whatever that credit amount was, that's what you paid to the state. So once the federal exemption amount started going up significantly, and that went away, the states were losing significant revenue. So they did what they called decoupling, which basically means now Massachusetts doesn't follow the federal rules. They basically use a calculation from back in 1999. And so for gross estate purposes, that's kind of the threshold you need to meet, is only $1 million. So when you think about it, living in Massachusetts, if you have a home, a retirement plan, maybe a life insurance policy, it's pretty easy to meet that. And so I think a lot of people are really surprised when they actually look at a loved one's estate and say, oh, okay, I actually do need to file in Massachusetts.
Okay. So let's say that your estate is greater than $1 million in Massachusetts, or even greater than the 5.4 million number for federal purposes. So in the event that you're above those thresholds, what kind of tax rates are we talking about here? How much would you end up paying in taxes?
Well, it's different for federal and Mass. I mean, if you really were significantly wealthy and were subject to federal tax, it's up to 40%, where Massachusetts goes up to as high as 16%.
Okay.
The other thing to kind of keep in mind and how the calculation works, just because $1 million is kind of the threshold for filing, that doesn't mean that's the exemption amount. And I think that's what a lot of people don't understand. And essentially, there's two things to keep in mind. Number one, it's the assets that you hold as of the date of death. And also, it's any taxable gifts. In other words, if you file those gift tax returns, in your example, that $6,000, that gets added back to whatever your value is at the date of death to determine whether or not you meet that threshold. If you meet the $1 million threshold, the exemption amount actually is only about $100,000 because of the way the calculation works. And just in a simple term, you basically say, okay, here's all my assets, take away liabilities, all the allowable deductions, you come up with a number, and that's your taxable estate.
So this is net assets. In
Net
other
assets.
words, if you have a mortgage on a property, you deduct the value of the mortgage at the date of death from the value of the property in coming up with your net assets.
That's correct. And you can deduct things like funeral expenses, administrative costs, that type of thing, any debts, you know, even credit card debts, all that kind of thing that you had as of the date of death. That reduces your taxable estate.
One thing that I find interesting too, this difference between federal and Mass, as you pointed out, for federal it's an exemption amount, but for Mass, let's say, so we know the threshold is $1 million. If you have $999,999, there's no estate tax. But let's say you're $1 over the threshold, so you have $1,000,001. Now the entire $1,000,001 is subject to Massachusetts estate tax. It's kind of a peculiar calculation, and I think sometimes people don't realize that it's not that the first million of your assets gets sheltered from Massachusetts, or exempted, I should say, from Massachusetts estate tax, but rather it just means that once you hit this threshold, now you're required to pay estate tax, and oh, by the way, it's on the entire amount. That's pretty different than a lot of other tax calculations.
It's true, and you know, it's a very odd system, because basically when you file a Massachusetts state tax return, you basically are creating a federal return based on the law that was in existence in 1999. And the bottom line is, it's, you know, you come up with that net estate, as we just talked about, you subtract $60,000, and then the first $40,000 is a 0%, and then it is just it's a graduated rate from there. So if you think about it, really the only first 100,000 is completely exempt. The good news is that it's a relatively low tax rate. But you know, if you have a significant estate, it's as high as 16%. So I think it's important for people to realize that that is one of the liabilities that they need to deal with when they're dealing with estate taxes.
Yep. And now I wanted to ask you about somebody who is married. So being married can come into play here as far as estate taxes go. So even if you have an estate that's greater than this $1 million threshold that we're talking about for Massachusetts, that doesn't necessarily mean you owe estate taxes. So can you talk a little bit about how being married can impact estate taxes?
That's correct, and that's an important point. And what it means is there's an unlimited marital deduction, assuming that your spouse is a U.S. citizen, which we don't get into all that. But it means that if everything goes to the spouse, you get an unlimited marital deduction. And a lot of times what people will do is, you know, they'll have some go to the spouse, some go to family, and they try to figure out what's the best way from an estate tax point of view to do that. The other thing that's important to remember as far as the marital deduction is that there's a new concept called portability. And so what we advise clients to do is essentially, if you're going to have to file a Massachusetts estate tax return, file the federal return and elect portability. Why? Even if your estate taxes are low, is because we don't know what's going to happen in the future to estate taxes.
So just to explain portability for a second, and again, yes, this is something we talk about with clients. I don't want to make blanket recommendations, but everyone's situation is unique. But with portability, so that means that here on the federal side, you can have up to $5.49 million pass with no estate tax. Well, if your estate is less than that, there's an amount that's unused, and so by doing this portability, you're then porting it over to the other spouse. Is that generally correct?
Exactly, and you know, in essence, what it does is it doubles your exemption for federal purposes. And so, you know, and it's important to remember because as we had talked about, it's kind of a unified system. So the portability also helps with the gift tax side. And the reason that it's important is, like I say, it's a simple election. So it's on a case-by-case basis, but you may decide, you know what, it's worth actually filing the federal return because who knows, maybe I'll win the lottery, maybe I'll get some inheritance, or maybe they'll just cut way back on what that exemption amount is in the future, and I want to at least say, okay, at least I've you know, don't leave this on the table.
Now, what's interesting from a historical perspective that you talked about a little earlier is this exemption amount has changed over the years, and in fact, in the year 2010, I believe it was, there was no exemption amount at all. So the estate tax kind of went away for a year. And interestingly, so George Steinbrenner, the owner of the New York Yankees, happened to die in that year. Now, if there was an estate tax, there would have been a lot of estate taxes that his estate would have had to pay. But because there was no estate tax, the New York Yankees just passed to his children, which they would have anyway, but there was no estate tax that was ever paid on that transfer. Now, one of the things that happens with the estate tax is when you have an estate tax, the people who inherit the property get what's considered to be called a step up in basis. In other words, their new cost basis in whatever asset they're inheriting is now valued at whatever the date of death was for receiving that asset. In the case of Steinbrenner and the New York Yankees, there was no step up in basis. Now, I don't think his kids are ever going to plan on selling the team, but it's interesting that that was a very high profile example of this whole idea of step up in basis and of having an estate tax.
Right, and that's what I say. I mean, we can only, you know, no one can really know what's going to happen for future for estate taxes, but I think that's something that's important to consider, and that political consideration is, you know, for a lot of people, they're not going to worry about estate taxes for federal purposes because most people in this country are below that threshold. However, if the estate tax goes away and they lose that step-up in basis, that could have a significant impact on people.
Yeah, and we've seen this a lot when we're preparing tax returns for clients, when you're trying to know what the cost basis of something is that got sold. And it could have been something that they had years ago where, not that they inherited the asset from someone, but they may have been giving it as a gift. And that's got a different implication for cost basis than inheriting. So when you receive something as a gift, the cost basis for the person who's giving it to you carries over to you. So many times we have clients who, they got a gift as a child of some shares of stock, which of course it's a generous gift for a family member to give to them. But the records behind this, might have just been lost to time or poor record keeping. And now you've got someone who they sold the stock. It's 20, 30 years later, and you have to report this on your tax return. So, it can be very challenging to figure out, well, what was the cost basis here?
That's correct, and I think that's important to remember. And so that is a benefit of passing something through the estate as a step-up in basis.
Mm-hmm.
And another deduction that we haven't talked about, but I think it's important to keep in mind for people who are charitably inclined, is that there's an unlimited charitable deduction. So if you think about it, estate taxes, in essence, are really, you have the option.
Mm-hmm.
But, for a lot of people, they do want to pass something on to the next generation. So it's important to kind of understand not only the federal, but also the state estate taxes, and to kind of take that into consideration.
Mm-hmm. So earlier you said something about how you can make gifts directly to an educational institution, and that does not count toward that annual $14,000 amount. And I think that's important for people to be aware of. In addition to education, you can do that for medical expenses. So you can basically pay for education expenses if you make those payments directly to the institution, or pay for medical expenses if you make those payments directly to the institution. And you can do that for your children, for your grandchildren, for a sibling. You could do it for anybody. There's not necessarily a family requirement there. And I think we see a lot of clients really take advantage of that, because they recognize that this is important to education for people that we care about. And it's a great avenue for people to take into account for their planning and for helping their families.
And I think that's important to think about too, because when you're looking about this, it's really kind of a long-term thing that we need to think about. And for the wealthier individuals, especially as they get older, they want to do something to make their estate, tax liability, to lessen that burden for the people they pass it on to. And so this is a wonderful way of doing that without having any gift tax implications. And also, I think for the grandparents especially, it's a nice thing to see, like during your lifetime, someone actually benefiting from it. And as we know, I mean, college costs have skyrocketed. So for the families that have the wealth to do that, it's a wonderful gift to that next generation.
So let me ask you a question. So let's say somebody's on their deathbed, and they say, you know what, I recognize there's an estate tax. I want to just get rid of my assets. I'll sell it to you for $1, to the next generation. What are the implications of doing that? Can you do that? Is that real?
It doesn't really take it out of your estate, because when you think about it, well, there's two things. There's certain rules about doing gifts in anticipation of death, but in addition to that, you still have the gift tax, and the two are unified. So even if you'd have to either file a gift tax return, which would lower the exemption amount because you've already used it, or it would end up in your estate return, and you end up at the same place, basically. I think where you kind of would run into it is for Massachusetts purposes, because even though it counts towards that threshold, it actually takes it out of your estate. So there are rules that they try to block, these deathbed gifts, and particularly kind of bargain sales. That's not really.
Yeah, I think we see that sometimes, or we'll hear a story of somebody exchanged property for $1, and you think, well, how is that possible? And from the registries of deeds perspective, I mean, they don't look at how much it was and whether that's reasonable or not. So the legal ownership may have changed, but there are these gift and estate tax implications of doing these transactions that people need to be aware of and account for properly, because if not, you can run into some trouble with your taxes. And the last question here, so let's say we have a lot of clients who have property in Florida. I think here in the Northeast, a lot of people have property in Florida. They may go there for the winter. You know, what's the implications here? Because Florida, there's no state income taxes. There's no state estate taxes. So I think there may be an incentive for people to say, you know what, I don't want to be a Massachusetts resident. I'd rather be a Florida resident. So how does that work for estate taxes?
Well, there's a whole host of issues, and it's a facts and circumstances, and you have to really prove it was your intent to leave behind your domicile in Massachusetts and move somewhere else.
Mm-hmm.
So for instance, things like, changing your car registration, changing your voter registration, meeting the requirements to actually file in a certain state, because there's certain income tax rules as far as who's a resident and who isn't. And actually, Massachusetts, as of last month, they completely revamped their form. So the 706 and the non-resident return, it's all part of one return. So if you have any real estate or personal property located in Massachusetts, and you meet that $1 million threshold, you need to file a Massachusetts return. And it's a formula base, but they basically have a 4-page affidavit with a 5-year look back. So it's pretty, you really have to kind of sit down with somebody and do some planning. It's not simply, I'm going to just buy a condo in Florida and live there, be a snowbird in the winter. It's not that simple.
Okay. Yeah, we definitely see a lot of that in our office, and I know you do a lot of work with our clients about that. So thank you for all the work that you do, and thank you for coming on the show and talking with me about it, because it's interesting. I think people don't really understand it, and it's really important for them to come speak to professionals like us. So thanks for being here.
All right, thank you.
So thank you very much for joining us, and we'll be back next time talking about your money, your taxes, and your wealth. Thank you.